Welcome back to Factful Finance. Let's dive into one of the most powerful yet misunderstood financial phenomena: corporate mergers and acquisitions. Have you ever wondered what makes these massive deals tick? Is it just a battle of egos, or is there real economic strategy behind them? Well, today, we're peeling back the curtain on the economics behind these big deals and uncovering the financial intricacies that fuel them. Stick around because by the end of this video, you'll understand why these transactions are not just a game of corporate chess, but a matter of survival, expansion, and, yes, money. Corporate mergers and acquisitions, M&A, have the power to reshape industries, alter stock markets, and redefine global economies. But here's the kicker. Most of the time, people see these deals and think it's all about the numbers. The truth is, M&A is as much about psychology and strategy as it is about spreadsheets. Let's break this down in a way that'll leave you seeing the bigger picture. The first thing you need to understand is that M&A is driven by synergies. This is where the magic happens. When two companies combine, the goal is to create more value together than they could individually. Imagine you're watching a sports team. One player is great at defense and the other is a fantastic striker. Separate, they're strong, but together, they're a winning duo. In M&A, this synergy is what drives companies to pay a premium to acquire another. The idea is that the combined company will generate greater profits, more efficiency, and potentially a better market position. But what kind of synergies are we talking about? Revenue synergies come when two companies merge, and together they can generate more sales than they could apart. For example, think about how one company's product line complements the other, allowing them to cross-sell to existing customers. It's like adding a new layer of flavor to a dish that wasn't there before. Cost synergies, on the other hand, focus on cutting costs by eliminating redundancies, streamlining operations, or leveraging larger economies of scale. However, M&A is not all sunshine and rainbows. Many deals fail to live up to the hype. A 2020 study by Harvard Business Review found that up to 70% of M&As fail to create value for shareholders. So why does this happen? The answer lies in something we call overpaying. It's tempting to think the value of an acquisition is always greater than the sum of its parts, but often it's not. In some cases, the acquirer overestimates the synergies or misses key cultural or operational differences that make integration difficult. Take the case of AOL and Time Warner, a deal that was heralded as a merger of the century. At the time, the companies were valued at a combined $350 billion. Fast forward a few years, and the deal was widely considered one of the biggest flops in M&A history. Why? A failure to effectively merge their cultures, compounded by the bursting of the dot-com bubble, led to massive losses and eventually AOL's decline. Then, you have the matter of financing these deals. Acquiring a company isn't cheap. Most of the time, these deals are financed through a combination of debt and equity. This is where things can get really tricky. When companies take on too much debt, they risk over-leveraging, which means taking on more risk than they can handle. The last thing any CEO wants is for their company to buckle under the weight of financial obligations that stem from an acquisition gone wrong. So, what does it take to successfully pull off an acquisition? First and foremost, thorough due diligence. This means understanding not just the financials of the company being acquired, but also its culture, its people, and its operational structure. This is why M&A experts, often with backgrounds in finance, economics, and law, are in such high demand. Their role is to evaluate risk, forecast potential synergies, and ensure the deal is worth the price tag. Let's take a look at a real-world success story. Disney's acquisition of Pixar in 2006. Disney paid $7.4 billion for Pixar, and the deal has been widely regarded as a success. Why? First, the companies had complementary strengths: Disney's distribution power and Pixar's animation expertise. Second, Disney respected Pixar's culture, giving them the freedom to operate as an independent entity within Disney. This deal was carefully crafted, with a clear vision of how each company would benefit from the other. The result? A new era of animated blockbusters and a solidified position in the entertainment industry. Ultimately, M&A is about more than just the transaction. It's about creating long-term value. And when done right, mergers and acquisitions can accelerate growth, drive innovation, and lead to market dominance. But as we've seen, it's a high-risk game, and the consequences of failure can be massive. So, the next time you hear about a big merger or acquisition, you'll have a better understanding of the complex web of economics behind it. From synergies to financing to due diligence, these deals aren't just about buying companies. They're about strategically reshaping the business landscape. If you found this breakdown insightful, give it a thumbs up and drop a comment below with your thoughts. What do you think makes a merger successful? Or perhaps you've seen an acquisition that you think went completely off the rails? Let's chat. This content is for educational purposes only. Mentioning any companies or transactions does not imply an endorsement. Always consult a certified financial professional for personalized guidance. Looking to dive even deeper into the world of finance? There's more coming your way. Click the video on screen now to keep the learning going.